We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. Today we're going to highlight one of the services of the RTT Plus service, and that's review of the US economic condition. It's going to be a quick run through. If you want to get more detail or study the charts or keep live, you're going to have to be a member of RTT Plus. Just go to readtheticker.com and look under services. Okay, let's go. Here we have our GDP forecast model. The black line is monthly data and forecasts the red line. The red line is real GDP. The black line is the forecast of the red line. As you can see, we're forecasting GDP below 2%. Not a crash, just a slowdown. The green line is the Wilshire stock index and the blue line is inflation. So we're expecting a slowdown. Here we are looking at the yield curve. The red line is looking at the short versus the very long. I think it's the 3-month versus the 20. As you can see, since 1970, it has a pretty much 100% strike rate when the red goes below the zero of forecasting a recession within, let's say, 12 to 18 months. Bit of a worry. Now this is a very important chart. I'll just scroll down to my notes. Hang on a second. Right. The black line is the ratio of exports. Well, let me start again. This chart summarizes aggregate demand into the US economy. So this is I request this. I want to buy that. This is aggregate demand. So the black line is demand from exports. The grey line is demand from the US consumer, which is 70% of the US economy. The green line is it's business investment. So that's investment in plant, what have you. The red line is residential investment, and the pink line is government spending. And as you can see, in the last recession, we actually had 3 of these lines breaking down. That was exports, US consumer, business investment, and residential. In the 2002 crisis, we had exports, business investment, so that's 2 out of the 5. Okay, the US consumer a bit, but really that was an export and business investment slump. In 1990, we had a bit of a US consumer slump, we had business investment slump and residential slump. Exports held up, the government spending held up. That's why the reason why they call this the Great Financial Crisis is look at the rate of change. These are all relative, and pretty much everything except government spending went down. Now we had a bit of a slump in 2016, and as you can see, exports have not recovered. That's obviously because of the higher US dollar. You can thank the Fed for that. Raising rates probably too far. And you've got business investment, which hasn't really taken out the new high, and that's probably because of the acceleration of the trade war. And you can see the residential investment has flattened out. And government spending is just going nowhere. So everything's got a bit slower since, the US consumers pretty much been holding up the economy, which is 70% of the economy, so that's pretty important. So which of these lines are most important? Let's have a look at the next chart. Now, so before we go to that, I should say that if the US dollar gets stronger, the black line will continue to shrink, and so will probably business investment. This chart here shows how important each line are. Now, on the right scale, we've got the US consumer. On the left scale, we have everything else. On the right scale, US consumer is close to $13 trillion. That's right. Yep. And everything else is under $4 trillion. So this is exports, business investment, residential investment, and government spending. But when they all move together, it makes a big difference. Okay. Because GDP is only 1%, so 1% movement in GDP doesn't take much. Okay, this is why the US consumer is so important. This is personal consumption, PCE, and including food and energy, it's 70% of the US economy. Without food and energy, it's about 61%. Big jump. See this big red? See how it jumps from here to there? That is because of Obama's healthcare spending. The healthcare spending took more of a chunk out of the US consumer. I'm sure you're rapt about that. Now this is an interesting chart. The blue line is year-over-year change of corporate profits after adjustments, and the red line is potential GDP versus real GDP. So if real GDP fails to meet potential GDP, the red line sinks, and obviously it's highly correlated to recessions and hasn't started to sink yet. But what's very important is whenever the blue line is sunk below the blue line of a significant amount, there's always been a crisis associated with it. Now this is quarterly data, so it tends to happen after the fact, but we should note that the blue line is on zero now, so I would say it's vulnerable. It should be advancing, but yes, just corporate profits year over year have flattened out. I bet you the next 2 or 3 months of earnings are going to be not spectacular. They're going to be pretty much flat, if not bad. What we don't want to see happen is the blue line sinking there, but obviously some sort of crisis is going on. So here we had the 2016 spook before the most important election of all time, the slump, the great financial crisis. Here we had the, what was that one? I'll just go to my notes. A recession, and we had a stock slump there, and we had .com bust over here. And, well, there's quite a few back there. So if you're a member of RTD Plus, you can go through the notes. You can study each one of those. And here's the US dollar trade weight index. This is a problem. This is why the export aggregate demand is hurt. That's got to come down. And here's the Fed balance sheet. As you can see, they've started again. So as I said in the beginning, the GDP has slowed. Business investment has slowed. Exports are not doing as good, so aggregate demand is weakened, and the Fed is responding with QE, even though they're calling it repo, bailing up banks. But that's the start, so things are already happening. Now, this is the most important. Corporate profits, I just said it had gone flat year over year, and that's the red line. And one of the reasons why is a typical advance of wages and salary costs. As you can see, the poor old worker gets hit every time. Wages start to improve, hold up for a bit, and then a smack with a recession and everything is cut again. This is an interesting one. This is residential investment. The black line is the residential investment. As you can see, it's quite low. This is the value of residential investment, and the red line is the sale of new family homes, and the green line is employment and residential construction. So if you look at the black line going back, it's actually this is a year-over-year chart. So the black line has pretty much slumped. Still activity, but not as great as it could be. I'm quite concerned because it's similar to the 1990, we're going to the lows. So maybe that's why Fed's doing QE to get things going again. Pre-recessionary levels, I should say. This one here is quite important. The red line is heavy truck sales. The black line is the construction of the heavy truck, and the green line is Dow Transportation Index. So it's a pretty good indicator when it starts to fall. People aren't buying heavy trucks to move stuff around because there isn't the demand. Heavy trucks are quite expensive, you know, $200,000, $500,000, $1 million. So at the moment we got a bit of a dip here, but that dip is, yes, it's a bit of a concern. But we'll have to watch this as we go forward. A lot of this correlates to the slower GDP. And this chart here is quite interesting. The red line is institutions putting money into money market funds, and the blue line is retail money market funds. So it's a kind of the dumb money versus the smart money. But what's most important is the rate of change in the red line. It's accelerated. Now this is we have to consider from 2009 onwards, because this is the money printing period. As you can see here, we had a jump in 2016 as a concern of slowing economy, bit of a comeback as they talked up the stock market. But look at the rapid rise in the last 3 or 4 months in institutional money market funds. Maybe they're waiting for QE, or it might reverse after Fed action. Obviously the retailers diving into money market funds quite aggressively. This period here is different from this period back here because the interest rates are much, much lower. So you wouldn't want to put money into a fund only 1% when the dividend yield was 2%. Back here interest rates are 3 or 5%, so it was it was a good yield. So if you're putting money into a money market fund now, interest rates are so low, you only just want to get your money back. So that is pretty much a concern. This chart's pretty important. This shows US household wealth is highly correlated to the inflation adjusted stock market. So US household wealth, once again you can see bubble 1, bubble 2, bubble 3, and its correlation to the inflation adjusted stock market. Okay, no bubbles. Bubble 1, bubble 2, bubble 3. So you wonder why the stock market's been held up or been looked after by the Fed with QE, because they know the households and the Main Street America would be crushed if it collapses. So once again, if you want to follow these charts, examine them day by day and see monthly changes, become a member of RTT Plus. Once again, main chart is the GDP is slowing, and as it did in 2016, it slowed into the US elections, so I suggest that we may see it slow, and we'll have to watch if it sinks further if there is a recession starting. Thanks for watching.